On October 30th, Mr. Donald Trump and Xi Jinping finalized a new trade agreement in Seoul, South Korea, hailed as a remedy to cool down the global economy. But whose pockets did this cooling actually burn? Is the tariff rollback genuinely easing burdens, or is it the start of a new round of maneuvering? First, let's look at the background of the U.S.-China trade war. After joining the WTO in 2001, China's exports surged from $266 billion in 2001 to $1.4 trillion in 2002-2008. Even during the 2008 global financial crisis, when the U.S. economy contracted by nearly 2%, China still grew by 9.8%. China's success did not rely solely on free market economics. It benefited from long-term state macroeconomic planning, exchange rate policies that supported exports, subsidies, loans, grants, infrastructure investment, and a state capitalist model that could control production costs. If you were the president of the United States, you would have to pay very close attention to this. In 2018, the U.S.-China trade deficit reached $379 billion. And then, President Donald Trump began repeatedly imposing tariffs on a range of Chinese products, pushing the average tariff rate up to about 20%. China responded with reciprocal measures, imposing tariffs on U.S. exports to China that also averaged around 20%. And it reduced purchases of U.S. soybeans. When Joe Biden took office in 2021, his administration continued the policy of levying tariffs on China, and the trade conflict continued to escalate. On April 2nd, during his Liberation Day speech, President Trump accused China of erecting tariffs and non-tariff barriers of up to 67% against U.S. products, and announced that, as part of a reciprocal tariff policy, U.S. tariffs on Chinese goods would be raised another 34 percentage points. China retaliated with matching tariff rates, sparking an eye-for-an-eye trade war. On April 11th, the White House announced that tariffs on Chinese imports had risen to 145%. Hours later, China announced it would raise tariffs on all U.S. imports to 125%. At the same time, China imposed restrictions on soybeans and rare earths. Soybeans hit the livelihoods of American farmers, while rare earths squeezed the throat of the U.S. high-tech industry. Let's start with soybeans. This is not just an agricultural product, it's the economic lifeline of American farming. U.S. farmers were caught in the middle of rising trade tensions. China is the largest market for U.S. farmers. U.S. agricultural exports to China total about $29 billion. In Iowa and Illinois, soybean farmers get roughly 45% of their income from Chinese orders. But once the trade war broke out, China effectively imposed an informal embargo on U.S. soybeans. And U.S. soybean exports to China plunged nearly to 0-0 in the first half of this year. This is not a numbers game, it's real money lost. A September USDA report shows U.S. soybean stocks have reached 316 million bushels, a 5-year high, enough to fill 12 Hoover dams. Data from the Iowa Soybean Association are even starker. The average Iowa soybean farm lost $387,000 this year, a 220% increase in losses from last year, and 12% of farms have filed for bankruptcy protection. Now, look at rare earths. Without rare earth elements, the US F-35 fighter could not be built. Tesla batteries would be hard to manufacture, and even your iPhone camera wouldn't function. In the global rare earth supply chain, China accounts for 69% of mining and 91% of processing capacity, an absolute advantage built up over decades. So China's informal embargo on U.S. soybeans and its controls on rare earth exports pushed the trade war to an even hotter stage. This was turning into a no-winner conflict. In May, the two sides met in Switzerland to try to ease tensions by lowering tariffs. The U.S. agreed to reduce tariffs on Chinese goods to 30%, while China agreed to lower tariffs on U.S. goods to 10%, with both sides agreeing to reassess after 90 days. Afterwards, the U.S. and China held multiple bilateral talks in London, Stockholm, and Madrid. During that period, China agreed to lift rare earth export restrictions, the U.S. agreed to relax some chip export controls, and both sides agreed to extend the so-called tariff truce. However, by September 2025, the situation flared up again. The U.S. Department of Commerce introduced the so-called 50% rule, imposing sanctions on certain Chinese firms. President Trump also announced a 100% tariff on Chinese imports planned to take effect on November 1st. China quickly responded by expanding controls on rare earth exports and by sanctioning 5 subsidiaries of South Korea's Hanwha Ocean that were linked to the U.S., a move meant to retaliate against U.S. port fees imposed on vessels associated with China, and a development that stirred market turmoil and diplomatic tension. In this round of the trade war, neither country gained a clear advantage, so they returned to the negotiating table, which led to the talks in Seoul on October 30th. On the eve of those talks, President Xi Jinping said the two sides had reached a basic understanding toward a deal. Which side faces greater risk in this contest? China or the United States? Who holds the upper hand? In fact, the long negotiations leading up to the talks mean each side holds key leverage capable of inflicting serious pain on the other. That is why both were willing to resume talks. China's leverage includes controls over rare earth exports, purchases of U.S. farm goods, especially soybeans, and cooperation on drug issues, particularly fentanyl. The U.S.'s key leverage is that Chinese exports to the U.S. still face U.S. tariffs, totaling more than 50%, a major drag on China's export capacity. According to multiple reports, the talks produced the following outcomes. The U.S. agreed to withdraw the so-called 50% rule, suspend related port fees, and materially reduce tariff levels by 10 percentage points, bringing the average tariff rate down to roughly 48%. China agreed to lift its rare earth export restrictions, likewise suspend port fees, and resume purchases of U.S. soybeans. The White House said China will buy at least 12 million metric tons of U.S. soybeans in the last 2 months of 2025, and at least 25 million metric tons of U.S. soybeans in the last 2 months of 2025 tons per year for the next 3 years. Additionally, on November 5th, China confirmed it would suspend the planned 24% additional tariffs on U.S. goods and retain a 10% tariff instead. The sides also discussed easing chip export restrictions, but did not reach a concrete agreement. President Trump hinted that any relaxation would not cover the most advanced chips. To sum up, the October 30th agreement means lower tariffs to ease the burden on U.S. businesses and restored soybean purchases to help American farmers. For China, postponing stricter rare earth controls buys negotiation space while protecting core interests. But the contest is far from over. The U.S.'s 48% average tariff remains in place, and China still holds its rare earth trump card. Future confrontations will likely be more covert, shifting the battleground from tariffs to technical standards and supply chain rules. 2 final questions for you. How long do you think this agreement will hold? If you were a U.S. soybean farmer, would you immediately increase planting acreage? Leave your thoughts in the comments. Don't forget to like and subscribe. See you next time.